So I have decided to just do module 6 and then call it a night today because I'm like so tired. Anyways, so module 6, foreign exchange and commodity price risk management. So before we go, there are these two terms that I want to remember: bid and ask. So when you're a dealer, bid is when you buy something and ask is when you sell something. Part A. Foreign exchange risk is the risk of variation in exchange rates on an organization's profitability and net value, as measured in the organization's functional currency. Currency war is the process by which sovereign nations seek to devalue their currency against others to gain competitive advantage. So competitive devaluation is when you're seeking to reduce a real price of exports through reduction in exchange rates. Through loose monetary policy, increase cost of imports and decrease the export prices. And this leads to risk of creating inflation and debasing its currency. So currency war is not a good thing because it's not natural. If your currency is lower, then there's gonna be increase in export because people would like to buy more of your stuff. Another thing is currency peg. That is when there's a fixed exchange regime. To moderate the inflation risk, countries may increase its domestic interest rate. It may increase the yields on domestic interest-bearing assets, or it may encourage higher exchange rates. A term called commodity currency is known for countries such as Australia, New Zealand, Canada. This is a currency that is significantly influenced by a commodity or commodities. We're gonna look at how financial instruments are used in each scenario. So when you want to purchase or sell currency, then you will want to use spot market, which operates like any other purchase or sale of commodity. If you want to lock in a known future Australian dollar value, then you will want to use foreign exchange forwards or futures. If you want to adjust timing of cash flows or currencies, then you will want to use foreign exchange swaps. If you want to manage the risk return trade-off, then you will want to use foreign exchange options. And financial engineering encompasses the whole forward, future, swaps, options, and spot market. There is a term called two-way prices. Usually when you write down currency, you would say Australian dollar / US dollar. For example, 0.9000 - 0.9055 or 0.900/55. So this means for $1 Australian dollar, you're gonna buy US dollar of 90 cents and you're gonna also sell US dollar at 0.9055. The spread of this is 55 points because I would buy this Australian dollar at 0.9 US dollar and the dealer will sell 0.9055. So difference will be 55 points. When you look at the quotation conventions, if it's written as Australian dollar / USD, then the first currency will be called base currency and the second currency will be called terms currency. Base or commodity currency is the currency being bought or sold, and terms currency is the other currency in the quote. So there is a formula for forward rate, which is the spot rate times 1 plus terms interest rate times D divided by Y over 1 plus base interest rate times D divided by Y. And we're gonna look again at the risk management framework. So the first step is to set the core criteria. So this would include putting foreign exchange exposure into context of the organization's key strategies and benchmarks, looking at functional currency, business drivers, and key strategic objectives, looking at identifying exposures. This would include committed exposures, for example, sales or purchase contracts in a foreign currency, or cash flows such as royalty payments, or uncommitted exposures, which is like forecast but not yet contracted exposures. So those are like potential transactions that can be anticipated as part of firm's business. There are different types of exposures when it comes to foreign exchange. Transaction exposure is to do with paying or receiving foreign currency and it needs to convert it back to its functional currencies. OPEX and revenue exposure is to do with underlying exposure item reported in the P&L, and for CapEx, transaction exposure is to do with the statement of financial positions. Usually when you talk about transaction exposure, it's to do with P&L side of things. Whereas translation exposure, it has to do with asset or liability in different currency. Competitive exposure is when a competitive sources its goods from different country. So there's no direct exposure, but an example of this would be Australian manufacturer and Korean firm selling cars in Australia. So Korean car maker in Australia. Economic exposure is an exposure that is known but not yet quantified. So for example, for an Australian copper mining company with a mining life of 20 years, if it's selling in USD, it doesn't know exactly how much copper will be extracted and when it will be sold and how much it will receive for the copper. So that is the economic exposure. It can't be quantified, but it is known. And there's another thing called economic accounting exposure. That is the foreign exchange exposure from revaluing USD loans. So that is to do with accounting treatment. Another main thing to think about is hedging with cross-currency interest rate swaps. So CCIRS is an agreement between two parties to exchange interest payments and principal denominated in two different currencies. So for example, paying a fixed interest rate in home currency and receiving a floating interest rate in the currency of the loan. So just a brief overview of how it works. At the start of the contract, Bank X, which is the debt provider, gives a loan to Company A. So Company A receives USD loan of $2 million. At inception, under the CCIRS, Company A wants to lock in a CCIRS with Bank Y. So it will pay the same amount it received from the Bank X, which is USD dollar of 2 million, and Bank Y will give Company A the same amount in Australian dollar at spot rate of 0.9. Over the term of CCIRS, Company A is gonna pay the interest in Australian dollar as it received Australian dollar of 2 million at 0.9 spot rate. So it will pay interest rate at Australian dollar amount at BBSW plus cross-currency spread plus credit margin and bank's profit margin. Whereas it will also receive USD dollar of 2 million at LIBOR rate of 1%. So it will pay interest in Australian dollar and it will receive USD interest as well. And at maturity, it will repay the Australian dollar principal to Bank Y and it will receive the original USD 2 million that it gave. And over the life of the loan, as it received the 2 million USD dollar from Bank X, it will later pay USD dollar of $2 million. Another thing called single currency basis. This is when corresponding floating rate positions are reset off different indexes in the same currency. The reset indexes are generally for different payment periods. For example, 1 month versus 3 months. And cross-currency basis is similar to single currency basis, except the principal and interest payments are being made in separate currencies. So the first one is made in same currency and this one is made in different currencies. Therefore, are set off differing reset indexes.